Before we consider the components of the audit risk formula, let's take a look at the financial reporting system. A client's financial reporting system can be manual or computerized or a combination of both. For our purposes here, we're going to look at a very manual system to make sure that we're very comfortable with the concepts before we take our audit risk formula any further. A client needs to summarize the transactions that take place on a daily basis and represent them in the financial statements. There are various ways of going about this. There are various packages, various methods they can use. But at the end of the day, the idea is to ensure that the transactions that take place are accurately represented on the financial statements. Most clients will create a document for the transactions as they take place. These will be taken to journals that will be updated to general ledgers. A trial balance will be created and the financial statements will be generated from those. Let's assume that a sale has taken place for 10 Rand within this organization. A document should be created that represents the same 10 Rand along with the details. This should be journalized to indicate the debits and the credits. The general ledger will be updated. The trial balance will include that 10 Rand and that 10 Rand will land up on the financial statements. Note that within the financial statements, this 10 Rand is unlikely to show up on the face of the financial statements. Rather, it will be included in the sales account as a whole. The reality, obviously, is that that particular amount within the sales account should still represent the initial transaction that took place. The reality is that something is likely to go wrong somewhere along the line. Let's assume that the sales clerk wasn't paying attention when he processed the journal, and he accidentally processed it for 12 Rand instead of 10 Rand. Because this is a process, it means that this 12 Rand is going to flow through to the general ledger, through to the trial balance, and eventually this error is going to land up on the financial statements themselves. This is called a misstatement. The financial statements are misstated because the transaction that originally took place has not been presented accurately on the financial statements. These errors are known as inherent risks. There are various types of inherent risks caused by various different things, which we'll take a look at now. Inherent risks are known as natural susceptibilities to misstatement. Things are likely to go wrong just because of the nature of that transaction. For example, very complex or difficult calculations will increase the risk of your accounts clerk getting it wrong. Transactions that are being done by the company for the first time are more likely to go wrong. When we are dealing with cash transactions, there is more likely to be a risk of theft, and therefore this will cause misstatement as well. Inherent risks are generally referred to as the same as genetic weaknesses. Because you were born to the parents you were born to, there are certain weaknesses and predispositions within your genetic makeup that will make you more susceptible to certain illnesses, certain disorders, etc. These are inherent risks.